Good afternoon, everyone. Bill Bronchick here, live for Webinar Wednesday. Back again. Took a little pause there. I had to move my office and a couple of other logistical life issues dealing with, but we'll try to be back every Wednesday with a live webinar from 12 to approximately 12:30 Mountain Time. So I'm going to give a second for people to get logged on here, and then I'll be back in just a moment. Hi, Bill Browncheck back here for live for Webinar Wednesday. Today we're going to be talking about a great topic, which is LLC tax strategies for real estate investors. A lot of people have confusion about how to use an LLC or a corporation or any entity for real estate investing. So I thought I'd demystify some of those issues and clarify my suggestions on how to properly use, particularly an LLC, for real estate investing. And first, I'm going to lay a background so you understand what the tax issues are involved, and then how to use an LLC to achieve the goal of minimizing taxes, potential mistakes and tax penalties, and interest and audits and so forth. So there's different types of real estate income. I put here there's basically 5 different types of real estate income. And the first one is rental income. Most of you are familiar with that. If you've got a single family, multifamily, commercial, you're collecting rent. That's one type of income. There's also, from the sale of real estate, capital gains income. Now, they're short and long term. If you hold a property less than 12 months, it's a short-term capital gain when you sell and get proceeds. If you hold more than 12 months, it's called a long-term capital gain. The fourth type is ordinary income, and that is activities that aren't within those 2 categories. It doesn't involve the sale of real estate per se, although it can in some cases. It doesn't involve the rental or the income from real estate. But, for example, wholesaling. Wholesaling is an activity in real estate where you make income, but it's not really real estate income. It's akin to brokerage income. It's like a brokerage commission, even though technically it isn't by law. For tax purposes, it is treated the same. And then there is the 5th type, which is interest income. If you are selling, for example, with seller financing, or you are lending money to another investor and collecting payments of interest, that's another type of income. And each type of those is treated slightly differently. And what you're doing may not neatly fit into one of those 5 categories, as we'll discover. So in terms of the treatment of real estate incomes fall into 3 basic categories under the tax code. So you have one is what's called ordinary income. Ordinary income is the income that is earned from doing a business or running a business. So if you bought and sold widgets and you earned income, that's ordinary income. If you performed a service and was paid for that service, that's ordinary income, like a brokerage fee or an assignment fee in the real estate example. And that type of ordinary or also known as earned income is subject to income tax as well as FICA tax. So you're paying Social Security, Medicare tax on the earnings of that income, that type of income, and it's taxed at ordinary tax rates. As an individual, if you're doing that type of activity, it's the ordinary tax rates, which depending on what category you fall in, what the level of total income for the year you fall in, will be taxed at that particular rate. But between state and federal income, depending on where you live, if you live in California, you could be paying state and federal of 50. If you're living in a no tax state like Florida, it depends on what you're in, but you'll be in the high 30s. The next category for IRS treatment is the passive income and short-term capital gains, which are pretty much treated the same. They're not subject to FICA tax, and they are also taxed at ordinary tax rates. So if you buy, fix, and sell a property in less than a year, it's treated not necessarily as ordinary income, although it can be, as we'll discover. But if it is truly a short-term capital gain, such as buying a property, fixing it up, intending to rent it, and then you decided to sell it, or you rented it for 6 months and then sold it, maybe on a lease with option, might be an example of that. And if it's less than a year, then that would be taxed at ordinary rates, but it would not be subject to FICA tax. It would be reported on Schedule D of your personal income tax return. Passive income, such as interest and rentals, are reported on your Schedule E. I don't know how to do that with my fingers. Let's see. Is that sort of like an Yeah, that's sort of like an E, right? Of your personal income tax return. Ordinary income, on the other hand, is on Schedule C, self-employed business, which is subject to FICA tax. It's ordinary earned income. Long-term capital gains, so if you buy a property, hold it for 12 months or more, and then sell it a day later or a year later or 10 years later, it's a long-term capital gain, not subject to FICA, but is subject to a lower rate than ordinary tax rates. And we're talking all these as an individual, okay? And you say, well, I have an LLC. How does that apply? Well, we'll get to that. We'll get to that. It may be the same thing in many cases. So if you bought a property and then rented it for a while, and then decided to sell it and then had a capital gain, it would be capped out at a 20% rate for now. If you're in a lower income tax bracket, it could be 15 or 10, depending on your total income, but more likely 20% if you're an active real estate investor. Now, there are different types of real estate income. As we talked about, we have a rental income, we have capital gains, short-term capital gains, long-term ordinary income, and interest income. And the categories, let's talk about the specific activities as they relate to those categories, and then put them where the IRS would treat them. So rental income is clearly passive. Now, there are some exceptions to that. For example, if you're running a lodge, if you are doing Airbnbs, could that be considered business income and thus ordinary income? I guess it's possible. But we're talking about regular, long-term rentals, leases, 6 months or more. It's going to be regular passive income. It's not going to be subject to FICA tax or anything like that. So it's treated at ordinary rates, depending on your net passive income, but it's not subject to FICA. If you sell a property held greater than a year, it's a capital gain. Okay. If you sell a property held less than a year, it's a short-term capital gain. So greater than a year long-term, lower rate. Less than a year short-term, not subject to FICA, not ordinary, but Schedule D income. Flips and wholesales. Wholesales definitely ordinary income. It's earned income. It's like a real estate commission. On the other hand, flips, if you buy, fix, and flip in less than a year, could it be a short-term capital gain? Yes. Could it also be ordinary income? Yes. Depending on how many and how frequently you do them, as we'll discover when we talk about the dealer tax issue. So that's very, very important. If you're doing a lot of flips, if you're doing wholesales, that's definitely earned income. It's definitely ordinary, and you don't want to be doing that as an individual. If you earned interest, so you sold a property with terms, or you lent money and you're earning interest, and that's generally passive income at ordinary rates, not subject to FICA tax. Let's talk about the real estate dealer activity and why it's so important. I know some of you have heard of this, and some of you are very afraid of it. I don't think you should be super fearful of it, but I think you should be aware of it and mitigate it the best you can. So a real estate dealer, according to the IRS, is someone who buys real estate and keeps it as inventory, like cars in a car business, and then intends to immediately or quickly resell it. Now, of course, if you're fixing and flipping, that's exactly what you intend to do. Even a wholesale, if you bought it and took title and then turned it over and flipped it, that's clearly dealer activity. What are the consequences if the IRS tags you, the taxpayer, as a dealer? Well, number one, it does not qualify for 1031 exchange treatment. So you can't buy, fix, and flip and then use the proceeds of that to roll into another property and defer the gains. Now, there are exceptions to that. If it was truly a short-term capital gain property where you bought it in February, you fixed it up a little bit and you intended to rent it, and then you got lucky 6 months later and sold it. Someone made you a crazy offer and you sold it. Could that qualify for an exchange? Yes, it can. But if you do that over and over again, it's just, you're not that lucky. The IRS auditor is going to say, no, you're not that lucky that it happens all the time. If you bought a property, leased it with an option to buy, and the tenant exercised in the same year, could that qualify for an exchange and not be on the older property? Yes, absolutely, absolutely. But generally, if you buy with the intent, and they're going to look at like how many properties you do a year, what's the average hold time? Did you rent it first before you sold it? Did you at least try to rent it first before you sold it? So they're going to look at a number of factors and make a call on whether or not this is dealer activity or whether you, as an investor or as a taxpayer, are a real estate dealer. And so those properties won't qualify for exchanges if you did them, and they won't qualify for installment sales either. This is a biggie. If you buy property and then immediately resell it on terms like you buy and wrap, buy subject to and wrap, buy subject to and wrap, buy, put financing on it and wrap, buy it cash and sell it terms, whatever. That activity, if it's dealer activity, doesn't qualify for installment sales treatment. So you can't defer the capital gains by saying, I'm not receiving all my profit at once, IRS. I'm receiving it in little pieces and reporting it as an installment sale. Therefore, I want to defer my taxes on that gain over the 30-year term of the loan. You can't do that. It's also subject to FICA tax, and that's a biggie. So if you're an individual and you did a short-term capital gain reporting on Schedule D, which is not subject to FICA tax, and then the IRS audits you and says, no, we're going to put that on Schedule C as ordinary income, that could be problematic. Let me give you an example. Let's say you buy and sell immediately and claim it a short-term capital gain, and you do it a lot. You make $100,000 a year for 3 years. Well, after a 3-year audit, they can go back 3 years and say, no, we're going to reclassify that as inventory and put all that activity on Schedule C instead of Schedule D, which is a self-employment business, which means everything that you did for 3 years, the $300,000, is subject to 15.3% FICA tax, which is substantial. Number one. Number two, they're going to hit you with penalties and interest for the last 3 years, and that could be pretty fatal. So how do we mitigate that? How do we avoid it? The best way would be to use a corporate tax structure. When I say corporate, I mean C or S Corp. For most people, it's going to be S Corp. Some people might go C Corp, but we're talking about LLCs here, so just bear with me. Some people will go C Corp, but most people will be S Corp. So how does that work? An S Corporation is a pass-through entity, meaning the S Corporation reports its income and expenses on a return, an 1120-S. That's a corporate S Corporation return. The individual shareholders then report their share of profit, net, or loss, if there is some. So distributions that pass through to the shareholders on what's called a Form K-1 and gets reported on their personal return as a net number are not subject to FICA tax. So you say, oh, that's easy. We'll just do an S Corp, do $300,000 in activity over 3 years and pay no FICA tax, guaranteed, right? Well, the IRS is really keen, and especially lately, on saying no, 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 no. Some of that activity involved your labor, therefore you have to take a salary for some of that $100,000 a year, and they're going to want you to take salary. And if you take salary, what do you pay? Well, it's FICA tax, it's payroll tax. It's the same thing as self-employment reported in a different place, but it's the same number, 15.3%. Okay, so what you could do as an S corp is, let's say you made 100 grand, and I say 100 grand net after expenses. What if you took a 30 or 40 or $50,000 salary? You pay FICA tax on that, and then the rest passes through without FICA tax. So you cut your FICA tax in half, which is better than doing it on a Schedule C where it's all subject to FICA tax, or getting audited where they move it to a Schedule C and pay it on all of it. Okay, so that's why people who have ordinary income use S corps like that. They take some salary and then they pass the rest through. Now, depending on how much income and how much labor you're performing, the IRS will say you should have taken more salary, or you're okay with what you took. But at that level of 100 grand, if you're taking 30 grand in salary and you're only doing it part-time, I think you'll probably fly. But the IRS, with that funding they just got from Congress, they're looking hard at that because that's where they get their money from. So just be aware of that. When I say use an S corp tax entity, just bear with me. We're talking about LLCs. Just bear with me. Okay. Don't do any non-dealer activity in the same LLC. Now I said S corp. An S corp can report as an LLC can report as an S corp for taxes, as we'll discover later. So don't do non-dealer activity in the same LLC as you do your dealer stuff, because if the IRS tags the entity, the filing entity as a dealer, then all of it could be subject to dealer implication, and you don't want that. So what you want to do is just claim your flips or your wholesales as ordinary income to an S corp, and maybe take some salary, pay some FICA tax, and the rest pass through without. That's the proper way to do it. Don't do it in your own name as an individual, because you're going to pay FICA tax on all of it. Now, for passive activity, that's rental income, interest income, you want to use a partnership format as an LLC, or what's called a disregarded LLC. I'll explain in a little bit what those terms mean, so you have an understanding how we use the LLC. Number two, you want to keep that income separate in that entity, separate from the dealer activity in another entity. And we're going to claim that as passive income, which is subject to ordinary rates, but not subject to FICA tax. So I threw around S corp, C corp, partnership, disregard. What does that all mean? Well, the LLC, the limited liability company, which is not the same thing as a corporation. It's not the same thing as a limited partnership either. And it's not the same thing as an LLP, which people sometimes call it. That's a limited liability partnership. An LLC is a limited liability company. All 50 states recognize them, and each state has a different filing requirement, but it's basically the same. You file articles or a certificate of organization with the Secretary of State, just how you would with a corporation. And then you have internal documents, such as an operating agreement. You get a tax ID number. You have resolutions like a corporation, and so forth. The IRS never came up with a tax return for an LLC. Isn't that interesting? So a corporation has an 1120, an S corporation is 1120S, a partnership is a 1065. So limited partnership, general partnership, limited liability partnership, all file 1065s, and then they issue K1s to their their partners. In an LLC, there's 4 ways it can be taxed. Number one is what's called disregarded. Now, if you're a one owner, you call the owner a member in an LLC. If you're a one member or single member LLC, then the IRS disregards the form. And then the sole member, reports that activity. Thus, if you as a single person, as a human being, are the sole member of an LLC and you are disregarded, that means you report as an individual on your personal taxes the activity. So if it's rental, Schedule E. if it's ordinary, Schedule C, and so forth. Okay. The snafu here is that most people set up single member LLCs if they're just a sole owner, and they go ahead and do it, which is okay, as we'll discover, for rental activity. But if you're doing wholesales and flips and anything that's ordinary income, you're reporting Schedule C. If you're reporting on Schedule D as short-term capital gains and you're flipping properties all the time, it's just a matter of time before they're going to move that to Schedule C, because you're reporting as a human being individual on a 1040. You understand? So generally speaking, an LLC where a single individual is the sole member that is disregarded for taxes is a horror show for ordinary income. Is a horror show. If you've been doing that, you probably want to stop and convert it into something else. Now, what's the next choice? Partnership. If you have two or more members, you are by default a partnership. Okay. Now, the IRS has what's called default classifications, which we'll talk about. And you can overcome those defaults by filing IRS forms. Okay. A partnership LLC would file a 1065, a partnership filing, just as if it were a general partnership without the LLC or a limited partnership. It's all the same, and everybody gets a K1 for their net loss or profit. And again, that's good for passive income. In a partnership LLC, if you and your friend are partners in an LLC and you're doing ordinary income, like let's say your real estate brokers or your attorneys or you're running a retail business or your mortgage brokers, the K1 passes through the nature of the income that is earned. So if you're earning earned income in that company, then your K1 will report with FICA tax. You understand that? Let me say it again. If you're a partnership LLC and you're doing ordinary income, your K1 income would be subject to FICA tax because it's earned income in the LLC that you ran. Again, not a problem for passive income. If you're a rental activity, a partnership is fine. S corporation is the next election. So you can have 1, 2, 3, 10 members, and you can be treated as an S corp, which we already said is the preferred entity if you are doing ordinary income. So if you're doing wholesales and flips and so forth that is earned or ordinary income, you probably want to go with an S corporation election. So it's not that you convert your LLC into an S corp. It's still an LLC under your state law. But to the IRS, you report as if it were an S corp under state law. So you still have managers and members like an LLC, but to the IRS, you're filing an 1120S and treated under the S corp rules as if you were in a regular S corporation. Does that make sense? I hope it does. So it's an LLC treated as an S corp, not an LLC converting to an S corp. You're not changing the nature of the entity with your state. You're just filing an election with the IRS. Okay. A C corporation is the fourth choice. Although few people do this, most people who do C corps just do regular C corporations, but it's a possibility. In most cases, people are going to be either S corp, partnership, or disregarded, depending on the nature of their income, and they may have more than one entity. By the way, if you have a question, feel free to post it. If you're signed up here for my streaming system, StreamYard, you can ask questions on YouTube and on Facebook. I don't think I can see those live, but I can see comments here. And if you have a comment, and oh, Joe Sugg has a comment here. Great information as usual. Well, thank you very much, Joe. I appreciate that. All right, so we move on. So there are default rules for LLCs you have to be aware of. So if you file an LLC with one member, meaning you go on the IRS website and say, it asks how many members are in the LLC, and you say one, it's going to default you to disregarded. It'll spit out a letter saying you don't have to file any taxes, file that on your personal tax return. Now, by the way, it's possible for an LLC to be owned by another company, like an S Corp or another LLC. In that case, the sole member, being another entity, would report the income and expenses, in that the entity it owns, the sub-entity, is disregarded. So, for example, if you had an LLC with two members as a partnership that reported as a partnership, that was the sole member of another LLC that owned, let's say, a rental property, that sub LLC would be disregarded, and then the master or parent entity, the partnership LLC, would report the income and expenses. But for liability purposes, it'd be a separate entity from the reporting entity. So you have state law that says two separate entities, and you have IRS law that says one entity. I know that's kind of bizarre and confusing, but it is that way. Okay, so if you go on the IRS website and say we have one owner or one member, and that's a human being, individual, that LLC is disregarded by default. Now, you can overcome that by filing a form with the IRS to say, no, I don't want to be disregarded. You have 75 days to do it, to say, I want to be an S Corp. Now, if you missed that window, and let's say you filed it in January of this year, when 75 days has passed, you can ask for what's called a late election for 2022. And say, I forgot, I didn't know, my accountant was supposed to do it, and he thought I was supposed to do it, and if that doesn't work, just say COVID. The universal excuse for everything. But if you filed this LLC 5 years ago, the deadline was 75 days from January 1st, which is March 15th. And the chances of you getting a late election at this point for 2022 are slim. But you can do it in 2023. You have till March 15th to be an S Corp for that year. Okay. Or you just form a new one if you need it right now, and just elect it immediately as an S Corp, and you're so elected for 2022. Now, by the way, two or more members, it's going to default you to a partnership. Now, what about husband and wife? This is the one when people get confused. If you're husband and wife, you can choose to be a partnership or disregard it if you file jointly. So if you go on the IRS website and get an EIN number and say, we have two members, it's going to force you into a partnership. That's not what you want all the time. If you want to be disregarded and just report your rental income in a disregarded entity, then you would sort of tell a fib to the IRS system and say it only has one member, and then report it on your joint return. Okay. But if you put two, it's going to force you into a partnership, when then you have to file a form saying, I elect out of that. I don't want to be disregarded. Okay. And you must elect out of the defaults, and must do so timely. It's Form 8832, and the timelines are on there. I think it's 6 months. But there's always a late election exception if you forgot. And again, you can change the election every year. You could say, I want to be S Corp this year and then terminate it next year. You could say, I want to be a partnership to start, and then say, no, I want to terminate and that bit and be disregarded next year. It's just a matter of filing some forms and reporting with the IRS. Okay. Okay. All right. Questions? Anybody have any questions? Feel free to pop them into the chat box there. And hey, we got William Tingle here. What's up? Sub 2 Deals. Hey, check out William Tingle's Creative Financing and Sub 2 forum on Facebook. It's a hot one. He does a lot of work, a lot more work than I do on mine. But he's encouraging me. He's inspiring me to do more of these. Okay. I have a question here. So someone says, can you clarify the husband and wife thing? Yes. If you are husband and wife as co-owners of an LLC, you can choose to be joint reporting and thus disregarded. And when would you do that? For rentals only. If you're doing flips, you'd probably want to do an LLC and elect as an S Corp, okay, by filing IRS Form 2553 within 75 days. And you have to also, if you're going to convert from a single member, if you're an LLC single member as a person, as a human being, as the sole owner, and you're doing ordinary income activities, you probably want to convert that to an S Corp. And you do that by doing three things. One, you're going to file 8832 to say I want to be a corp, and then two, file 2553 to say I want to be an S corp, and three, you have to amend your operating agreement to accommodate for the now tax treatment differently than you had before. Because before, your operating agreement, and if you don't know what that is, you should have one, by the way. If your operating agreement says you're disregarded and we're going to report disregarded, you need an amended operating agreement that says, no, we're going to be an S corp for taxes, and we're going to follow the S corp accounting rules, and so on and so forth. Okay. Well, and I have a little tickler here at the bottom. You can read that. It says, those of you who are watching this either live or on replay, you can go to legalwiz.com, my website, /store, or just go to legalwiz.com, click on store, and use the code webinar for a nice fat discount on any of my courses there, and that offer expires on Friday. So make sure you do that timely. I have a self-study course on how to do bulletproof asset protection, which includes LLCs, family limited partnerships, land trust, regular corporations, and other strategies for putting it all together. It has all the forms, all the filings, all the resolutions, all the different state-specific stuff that you need. It's a really amazing package. I've been probably on my fifth iteration of that package, and you can use that code webinar for a substantial discount. Okay. Thanks everybody for joining me today. We are just past the half hour. I don't want to make this more than 30 minutes every Wednesday. Otherwise, people start to zone out a little bit. But I hope that you've enjoyed this session, and you've enjoyed my new office here. I got a new background here. Isn't it beautiful? Spent a lot of time. My wife helped me put this together. So I hope you enjoy it, and I hope to see you on next week's Webinar Wednesday. Bill Bronchick saying goodbye. Thank you for joining, and God bless.